It's Fed Day, and we're dissecting Chair Jerome Powell's statements at today's meeting. Gary Wagner, editor of thegoldforecast.com, joins us today to talk about market action in response. Gary, welcome back to the show. Now, it seems to me that Jerome Powell is dovish today. His statements have moved the markets. Gold is up. Stock markets are up. How do you think he did? How do you think?
Well, I think in terms of soothing the market, he did exceptionally well. In essence, he really underscored the fact that interest rates aren't going up this year. They're not going up next year. And most likely, they're not going up even in 2023. They presented the dot plot, and that showed that it's a unanimous vote currently that there will be no rate hike this year. There were only 4 dissenters that came in terms of raising rates in 2022, 7 dissenters in 2023. But in all 3 years, the majority consensus was to leave interest rates between 0.25% in terms of the Fed funds rate.
Okay, so why do you think markets reacted the way they did now, Gary? Is it because of this statement that he wants to keep the Fed funds rate low until 2023?
I think what it was a combination of his acknowledgement that he sees the economy getting better. He's projecting GDP to go to 6.5, unemployment to tick down, but yet he said that he is fully committed to continue the current track, the monetary policy that is currently in place of low interest rates and expenditures of $120 billion per month in terms of their asset sheet. And he says that will continue the way he put it was for a long time. So what he's saying is they're going to let the economy really ramp up, and he's not going to change a thing, even though there's signs of improvement. He will not change the rates until we're at a post-pandemic period.
Now, he did say that,
I believe, is what moved the market.
Okay, he did say that we will continue to be accommodative until the job is done. I think there's a few ways to interpret that statement. One, the job is currently not done. The economy has not yet improved. And number 2, once it does, rates are going to go up. How are you interpreting it?
Well, at some point, rates will go up. But he did mention that although there are certain sectors that are doing well, he sees some weakness in other sectors. And the whole idea with the Fed was we always had that dual mandate inflation at 2%, maximum employment. He realized to get to maximum employment after the devastating effect we've had because of the pandemic, that he's willing to let inflation run hot. He's projecting it to go to 2.5. I think it might even go a little hotter than that. But the fact is, in the past, that would trigger a rate hike. That's how you control that inflation. If he doesn't do that, that means that there's basically going to be an elongated period of time of cheap money in terms of borrowing, free money in terms of fiscal aid packages. Realize we spent $4 trillion last year. They passed a $1.9 trillion this year. And talk is that they're not done. That's what Nancy Pelosi said the other day. She said that the pandemic will dictate when we have another round of fiscal stimulus. His main point was that the pandemic is what has affected the economy, and until the pandemic has run its course, he's not going to change his monetary policy. And that is what soothed people, knowing that, in other words, he was saying, listen, America, I've got your back. We're going to make sure that we can have a recovery, and I'm going to use every tool available to help facilitate that. And that is what really sparked the rally in gold as well as equities.
To me, what struck out is that he acknowledged that there will be inflation. I think that's significant, right? He said, we want to get inflation above 2%. Now, why is he saying that? Is he just changing the Fed mandate? Basically, he's saying, if I'm interpreting this correctly, he's saying he wants inflation to run hotter so he doesn't have to raise rates. So he's foregoing the controlling the inflation part of the mandate in favor of full employment. Is that what's going on?
Well, the way I look at it is he has kind of tweaked the dual mandate to put maximum employment at the number one thing he wants to focus on in lieu of where inflation goes. In other words, he believes it's more important to get everybody back to work than it is for inflation to tick up. And that is a adjustment in the monetary policy. Hasn't changed. They still don't want, inflation to run wild, 4 or 5%. But he is projecting by the end of the year that inflation will run to 2.5%. So he's already acknowledging that it's going to go past their former mandate of 2%. And he's willing to do that and keep rates where they are, even if that occurs.
What's going to happen if inflation does run above 2.5%? What's going to happen to consumer spending, real wages? What's going to happen to people's living standards? Are we going to go back into a recession? Could that happen?
I don't believe so. The idea behind his philosophy is if you get maximum employment, if we get the numbers down to where they were pre-pandemic, you're going to have a huge GDP. There's going to be more people working, and those people working will get wages that allow them to live. Now, obviously, at certain levels in terms of income, that will affect the day-to-day living style. But I believe that his mandate is to get as many people to work as quickly as he can, and that is what he wants to do to return to normal. And then also, you've got the fiscal stimulus checks hitting banks now, the 1.9 Rescue Act that Biden passed last week. Those checks are already going into bank accounts.
Okay.
So that will help if there is a little inflation, the fiscal stimulus.
What was his GDP forecast again, Gary?
He said that he's expecting the GDP to be forecast at 6.5% by the end of the year.
That's very high by American standards, isn't it?
It's in a robust number. It's the kind of number we always want. And it is pretty aggressive in terms of his statement. But between the Treasury and fiscal stimulus and government spending and the accommodative monetary policy, where they continue to add to their balance sheet, which means they're providing liquidity, I think that it's possible.
How do you think yields will respond to a 6.5% growth in the economy and rising inflation above 2.5%?
What we've seen, if that continues, meaning market sentiment is optimistic ahead of what the numbers are showing, and I think they're ahead of the curve, because when you anticipate where stock is and where it's going to go, you're looking down the road. And so I think the anticipation, will continue to be robust. The question I ask myself is, at some point, the Fed going to step in and work with, they really can't control short-term notes, but they can do something similar to what they did, I believe, in 2013. They labeled it Operation Twist, in which they bought certain yields, sold certain yields to kind of bring that into alignment. They haven't spoken about that, but he did say they would use every tool in their toolbox, and that is a tool. I think that if that gets really out of alignment, at some point the Fed might step in and start, selling the 10-year, buying the 30-year. That's what they did in 2013.
What happened to the markets in response to Operation Twist?
Well, that was as quantitative easing was kind of leveling out. They had QE1 to QE4. QE3 was what was called Operation Twist. And rather than allocating more money to their asset sheet, and they kept interest where it was, but they bought and sold different lengths of government bond securities, and that way to control the differential between the rates of long-term and short-term bonds and notes. After that was QE4. QE4 was really winding down, and the idea behind QE4 was they were actually going to purchase back some of those assets. Because if you recall, at the end of, as the recession in 2008 hit 2012 and 13, they accumulated $4.5 trillion of assets. They really swelled their balance sheet. So they decided, okay, we're going to try and liquidate. They liquidated, if I recall, and I might be wrong on this number, but about 300 billion, 400 trillion. They took it from 4.5 to about 4.3. And then they realized that if they kept doing that, that would dry up the liquidity. So they stopped that completely. And that was the conclusion of QE4. for back then.
Yeah, and I remember in 2013 they withdrew sort of their quantitative easing, or at least eased back in what we saw was taper tantrum. The markets really didn't like that. There's worry now they're going to have another taper tantrum. Do you see that happening? What's the risk of that happening?
My sense is that any mistakes that were made in the handling of the 2008-2009 banking crisis, if it's known to have caused severe or dramatic changes, they don't want to repeat it. And I think that they're being overcautious because of that. Whereas in former days, they would absolutely, if they saw inflation tick up, they would just ratchet the rate 0.25%. They would always be constantly adjusting it. Now they're saying, listen, forget all of that. This is a global pandemic. This is the worst that we have seen really since the Great Recession in terms of unemployment rates. We've never seen rates like this where we had, 12 million plus unemployed. The key right now is I don't believe they're willing to do things that they would not have done, say, 10 years ago, because they believe that it is necessary to return the country to its post-pandemic days and to a powerhouse in terms of the economy and still remain the number one economy in the world.
Right. So the other thing that I want to bring up is that I didn't see any indication of Powell wanting to implement yield curve control. Do you think yields will continue to rise because of that? And look, we had the 10-year at around 2% prior to the pandemic. We're at 1.64 today. Can it go up to 2%?
Well, pre-pandemic, it was at 2.2. And that's just an excellent point, David. He has shied away from any statement saying that they would attempt to mess with the yield curves. The truth of the matter is the Federal Reserve can't control the actual interest rates of the notes. They don't have that power. What they can do is buy certain ones and sell certain ones and have an influence on it. He has been hesitant. What he has said is that it will be a short-term move at best, and he's willing to let it run its course. In other words, I don't believe he thinks that it will go to these high levels like 2.2, and there's not a reason to act right now.
So let's put everything together then, Gary. How do you see nominal yields changing relative to inflation? In other words, where do you see real yields going?
I think that they might tick up a little bit or down a little bit. I don't see them moving up substantially higher. As long as Fed funds rates are extremely low, then the banks have the ability to get a lot of money very cheaply, and they can still make a profit with a 3-point spread or whatever spread their mandate is at the banks. So they don't have the incentive to see it go higher because they can make a good profit here. And when the money is as cheap to lend out, they're going to lend out a lot more than if interest rates go higher. So it's not in the interest of the banks, I think, to have higher interest rates. The Fed doesn't want it. And most importantly, this debt that we have been accumulating, and right now, let's say we're at $6 trillion so far, we make interest payments. The U.S. government makes interest payments monthly on those debts. And so it would be a devastating effect if interest rates ran real high and government debt became unbearable. And so that's something that they're very aware of. When you start putting on trillions in debt, you've got to pay the piper, and it's much easier to pay them back with low interest rates than moderate or high interest rates.
Okay, let's bring it back to gold now. As I stated earlier, the price of gold did move up higher in response to the statement when it came out. We're at around 1745 right now as we speak. Gary, is this the end of the bear trend that we saw in the last couple of weeks? Well, months actually.
Actually, I think that we are right now in a rally mode. It's what I'm calling a counterweight. If you recall, last time I was on about 3 weeks ago, we had just really broken below the 200-day moving average. It was trading at around 1,800, but it had come down from 2,088. It had been a slow, methodical drop. The fact of the matter is, when it broke through the 200-day moving average, that told me there's still downside that we're going to have to bear. and we would see lower pricing. And in fact, we did. It went down about $100 to 1680. The interesting thing is I've got a chart up on the screen. It is in what's called Henkin-Ashi format. And if you can see that, really what I'm really focusing in on is this high that comes in right here. That's the all-time record high. And the length of the time that it took to hit these lows is a multi-month length. And the key number to me has been the 61.8% Fibonacci retracement. That's at 1690. I believe the low was 1680. That is when we looked at the possibility that the market was extremely oversold, that there would be traders coming in to buy the dips. The problem was you had stronger dollars and you had the yield curves kicking up. But that we saw that pivot. And that's why I like this type of chart, because on a Henkin-Ashi chart, what it is the open is really fixed as the midpoint of the last candle. So for example, when you're looking at this type of chart, there's a couple things you want to watch. Body size is the first thing because it gives you strength of trend and the absence of upper wicks when they're red. But you will get this pivot candle, and that is this candle I've just pointed to. You notice how tails start to appear, and then you get this it's called a doji in Japanese, where the open and close are the same. And then we started to get these upticks. We did have this one day here. Now, if you convert this to a standard candlestick chart, what happens is you will get a lot more noise, for example, but it will give you the true prices. And I'll go ahead and change that right now. Yeah, when we do that, this is true price action. And so the day we recommended our subscribers get in, we were in at 1722. And it was based upon a couple of signals. The first signal really came in was this large green candle here is almost an engulfing bullish. The reason it's almost is it would have needed to open below the close of the prior day. In silver, you got a pure engulfing bullish, but you don't take that call until you get a confirming candle. Confirming candle is a higher high, higher low, higher close. We got that the following day. That's what triggered our last buy signal. And it's what signaled to me that the multi-month correction was over, at least for now. I think we might have one more downside leg, and this is Elliott wave theory, but once that is concluded, it resets the clock to a motive phase, and a motive phase will take us to a new high. Now, I don't think that will happen this year, but I do think that we are in tune for a pretty good rally here. I can show you some of the numbers that I'm looking at in terms of a forecast. Let me just switch this here. If you can see that chart that came up, this is basically the same thing. What I am looking at, rather than the Fibonacci retracement that I used from 1450 to 2088, on this particular one, I'm simply looking at the retracement. So I'm starting here, labeling this a fifth wave, and then I'm labeling this an A wave. So we get something like an A, B, C correction. And when you do that, you get a counter wave, and that would be our B wave. Typically on a counter wave, it will go anywhere between, call it 50 and 75% of the price move down, which is this area that I'm circling right here. So our projection is that we could see gold go to 1880 and as high as 1980. Okay. And basically the way that I look at it is we just simply project onto what we're anticipating this market might do. We've got a strong area of resistance at 1880. You can see that right throughout here. And I see really no major resistance points up until that point. Okay. Here you get a whole band of price action here. This is the upper end of the band right at around 1990. And so I am extremely bullish now, okay, interim term and short term.
Okay, Gary, I have one more follow-up question on that. Now, if you take a look at the Fed dot plot here, people are interpreting that as very sort of a very bullish outlook on the economy, because they're projecting in the longer term rates to go, the Fed fund rates to go higher. Should the economy improve, Gary, let's say to the 6.5% GDP recovery rate, what's going to happen to equities in relation to gold? Would just people go into equities and dump their safe haven assets?
There is the unique relationship between risk on and safe haven, that historically they work counter to each other. When it's risk on, they favor that over safe haven. There is an exception to that rule. We've talked about this on a couple of occasions. The exception to the rule is that when you have huge fiscal spending, and that concurrently is done where you've got a monetary policy that's extremely dovish, it will cause both U.S. equities and gold to rise in tandem at the same time. It's exactly what we saw in 2009 through the middle of 2011.
Yeah.
What happened then was in 2011, gold topped off, but the equities markets continued to run.
Okay, fantastic.
So what I believe is if we see it play out in a similar way, we'll pick up a rally that might be $150 higher in gold. You'll see all-time new highs in U.S. equities, such as the S&P and the NASDAQ. At the point that gold gets a little bit overbought, you could see the stock market continue to run and have some selling pressure in the precious metals or safe haven assets.
Gary, thank you so much. Fantastic update. We needed that today. Thank you.
My pleasure as always. Have a great day.
And thank you for watching Kitco News. Don't forget to subscribe. I'm David Lynn.